Okay, so welcome back. In prior segments, we've shown you the theory and the elements of CFD trading. Now we're going to put that all together and look at some trading examples. So first of all, when we make any trade, regardless of CFD, shares, options, what we need to be able to do first is determine the trends. Now, you can use different chart styles. You might choose candlesticks or open, high, low, close or bar charts, or you might choose Heikin-Ashi charts, which tend to remove the short-term noise because they're taken over 2 sessions and have the added benefit of smoothing other indicators out that we put on the chart. We're going to use some trend following tools such as ATR trailing stop dots with a 13-day moving average, a weighted moving average, or a parabolic SAR, which becomes an alternative to the ATR as a momentum indicator. So after we've determined the trend, we need to be able to identify an entry, an exit signal that suits our trading style. With a medium-term reversal, we could look at when the 13-period weighted moving average crosses out through the level out period or price of the ATR trailing stop at 2 and 14 setting. And that shows the medium to longer term trends because the level out price point does tend to keep you in the trend quite a bit longer. Or the short-term trend reversal signal could be when price action crosses through the 13-day moving average, only taking trades in the direction of the medium-term trend that's identified by the ATRs. The short-term trend reversal signal could also be used to pyramid the position or add to the existing position in the direction of the medium-term trend. So let's take a look at some trades. The other thing that we can do for that is look for a pullback to significant price support, either the rising trend line or horizontal support when we connect peaks and troughs by the trend line, or the support being confirmed by the price action holding above the ATR. We should ensure that the price action is above the weighted moving average at the time of entry. An ideal look for some 13-period accumulation alerts on the weekly chart support the 55 accumulation alerts triggering on the daily chart, which is always a very strong portent or pre-alert to a change in trend. Here we're applying the indicators and fitting the ATR trailing stop dots and the weighted moving average to a trend. So you can see here we have quite a long-term trend line where the market's continually making higher peaks and troughs. We've got our trend line itself running through and connecting the troughs, representing the uptrend. We have our weighted moving average representing and identifying the smaller moves within the trend, and entries when the price action moves above, breaks through the ATR and moves up through the weighted moving average as an entry signal, and the opposite when it breaks down through the weighted moving average and the ATR trailing stop dots. So typical signals that we use in a medium-term trend. And then we've got our pre-alerts, which are giving us preemptive signals of reversals to the downside, being the distribution, and to the upside, being the accumulation alerts. Here a very strong one, and here where we have the daily 13 setting accumulation occurring at the same time as the weekly one, and the long-term 55 here, and here the same, where we've got very strong reversal pre-alerts signalling the movement potential to the upside. Okay, so let's take our first trade, which is a short sell on ANN, and we're looking at the initial entry, short selling 500 CFDs at 24.72 and placing our stop loss above the horizontal line of ATRs at 25.85. We can see the details of our trade on the order pad over here, selling 500 CFDs of ANN at 24.72 with our stop loss here at 25.85, and we can see the details of our trade further in the bottom panel. So you can see our ATR trailing stop dots following the trade all the way down, going sideways and forming a plateau here where the market gets a bit choppy, then moving down when we see the market moving further. Over here, we've got our preemptive move of a potential reversal to the upside, supported here by the MACD. So here we have an exit position when we see the ATR dots leveling out to look at a little bit of choppiness here, and then switching to the underside of the price action, suggesting a change, a good reversal to the upside. And then we have the market price pushing up through the weighted moving average to confirm that reversal. So over here, we're buying back to close the position at 23.47. We have our cost to trade as in brokerage, our exposure, and the interest daily on the trade. So here are the results or the details of the trade. We're short selling on the 9th of October and buying back in January. So about a 3-month trade there. We've opened by short selling 500 at 24.72 and we've paid commission of 12.36. Our overall exposure is 12,360 and the margin required is 2,586. To close our trade, we buy those CFDs back at 23.47. We've got a commission again of 11.74. So our gross profit of $1.25 per share is $6.25. Then we need to take off our interest charge of 51 cents a day. There's a total of 54.06 and our 2 lots of brokerages, which gives us a net profit of $546.84 on the trade. So there's our short trade on the ANN. So let's now look at a long position, and in this case, once again, the same share, and we're buying our position or entering our long position when the market moves up through a parallel or horizontal line of the ATR. Once it's prior to that, we notice it's breached through the weighted moving average, but we're using this signal as a break up through the level of the ATR as our entry signal. So buying 500 CFDs, 23.47, and we're putting our initial stop loss down here below the troughs at 21.06 to sell if we're wrong. So we can see our order over here, buying a limit order, good to cancel at 23.47, with our stop at 21.06, our cost to trade 11.74, and paying $1.61 per day in interest. Moving up through the trade. So let's see how we manage this trade by maintaining our stop positions. So here we can see that once the market moves up and it's made a second pullback after our entry, we can then move our stop from 2106 up to the adjusted stop level at the horizontal ATR trailing stop indicators. And moving the market on, we're going to use this similar method as we move through the trade. So here we've moved up into considerable profit here, and we can see that our stock is going ex-dividend and paying 29 cents per share in February. Now, when you're in a CFD trade and you know it's going to go ex-dividend and you want to maintain the trade for the dividend, you need to make sure that you don't move your stop up too aggressively. And once again, we're using that level out period of the ATR, maintaining a greater distance away, if you like, from the price action, because we know the stock's going ex-dividend. So it goes ex-div here, pays us 29 cents per share and moves on and rallies. Here we go here. So after the ex-dividend, then we wait for the next horizontal level out of the ATR and move our stop up. And then we can move through the trade again. And once again, using the same method, as the stock takes a little bit of a pullback and moves on, we use the level out of the ATR to adjust our stop up. And moving through the trade, we then find we adjust the stop, small level out at this point, but the markets move quite a bit higher, as in the angle of the rally, and so we'll use our stop to go up a little bit more aggressively in this case, as we're getting potentially closer to a nice dividend. Excuse me on that noise, sorry about that. It's my little doggy. Until we move through the trade. And then we can see that we had our pre-alerts up here with distribution. We had the market make a peak, and we can see that our exit position has been triggered by this price moving down through our horizontal line of ATRs, moving down through our weighted moving average, and we have a flip of the ATR here. So we exit the position, or we get stopped out with our maintenance of our stop loss that we've continued to maintain through the trade at 25.78 over here. So let's take a look at the trade there. So in January, we commenced the trade by buying 500 CFDs at 23.47, paid 11.74 in brokerage. Our overall exposure was 11,735. We paid a 20% margin, and remember our stock went ex-dividend, paying 29 cents, which was $145 to add to our trade. 17th of May, we closed by selling out at 25.78, paid our brokerage again at a profit, net profit of $2.31 per share, which is overall was $11.55. So our gross profit with our added $145 of dividend was $1,300. Then we had to take out our fees and charges. Our interest at $161 a day was $183.54. That comes off. Our 2 lots of brokerages come off. So our net profit after costs was $1,091.83. So a nice trade in that regard, and that was achieved by continually maintaining that stop loss method using the ATR, which is very good at keeping you in a medium to longer term trade, and using that method to lock in our profit on the way up, and also to be able to execute the exit of the trade by the breach of that indicator. Now here's a straight and very simple example of a losing trade, in this case using the parabolic SAR at the standard setting of 0.02 and 0.2. So here we had a long buy entry when the market moved up again and the parabolic SAR switched from being on top of the downtrending action to being underneath the uptrending action, so entering at $19.19 and putting a stop loss at $18.63. So you notice that the market went up, and then we did have a reversal that we weren't expecting. Market falls down and we sell at our stop at 18.63. So notice our trade was calculated and entered when we opened the trade. So we bought at a limit order of $19.19, and if done, we placed a stop loss order at 18.63, which actually activated the exit from our trade. We had an interest rate per day at $1.51, and we had trading costs. So looking at our losing trade, we entered it by buying ARB CFDs 500 at 19.19. We had our commission, we had our overall exposure at 9.5 grand, and we were required to put down 19.19 in margin. We sold at 18.63. Commission again be paid at a loss of 56 cents a share by 500 CFDs, which was an overall loss of 280. We had to pay our brokerage at 19.06 and our interest at 10.57, so our total loss in this trade was 309. But it could have been much worse if we look back at the chart when the market continued to go right down to this level of below 17.50. So placing the stop when we entered the trade certainly saved that big loss, and we just took a small loss of 309. So the very important strategy of placing your stop in when you enter the trade. So some tips for CFD trading: only enter on a confirmed signal. So make sure that you've created and made a habit the signal for you to enter and to exit. Second important rule, place stop losses at the same time when you open your position. Do calculate your break even to make sure that the trade has the potential to give you some profit. Have a trade management plan, so make sure that you have a method for maintaining your stop positions and moving them up to lock in your profit. It's a good idea to limit the amount of open positions to 1 or 2 initially when you're learning, and make sure you track them closely, at least following them every day, and check your margin positions. And regarding your margin, use no more than 50% of your account in margin usage when opening new positions and when maintaining your current positions. So there's some really good tips for maintaining and for having success in trading CFDs. And this ends this presentation.